All right, joining me now with more on the jobs market, as we are keenly focused on that this week, as is the Fed, is EY Chief Economist Gregory Daco. Gregory, it's great to have you on the show this morning. And what do you make of these private payroll numbers?
Well, I think they do signal strength in the underlying labor market. We are in an environment where there is this gentle deceleration in job growth. Of course, last month in the payroll survey, we saw a massive hit from 2 hurricanes and a couple of strikes that reduced job growth to only 12,000 jobs over the month of October. We're expecting a bit of a rebound when it comes to the November data. We wouldn't be surprised if payrolls came in above 200,000 for the month of November, with a strong rebound in the manufacturing sector that was restrained by the strikes, and in the leisure and hospitality, as well as in the professional and business services, both of which were restrained by the hurricane's disruptions.
Of course, the ADP number does give us a sense of the private sector, but a lot of eyes do focus on that non-farm payrolls report that does come on the first Friday of every month. And consensus is that 214,000 jobs were added in the month of November. That does include government jobs as well. Is that your forecast too?
Yeah, the consensus is pretty close to our estimate. We're estimating that job growth was around 215,000, so right on the spot relative to consensus, with the private sector adding about 175,000 jobs and the government sector adding another strong month of 40,000 jobs. I think we're going to see some rebound in the goods sector of the economy, with manufacturing benefiting from the end of a couple of strikes. Construction spending, construction employment still remaining quite strong. And on the services side, we're likely to see some strong momentum in the healthcare, leisure, professional and business services, but perhaps a risk of a bit of a cool down in the retail space as well as in the transportation space, because we've heard that the staffing plans are relatively subdued on the retail front.
Well, you mentioned earlier just 12,000 jobs added in October, and that was due to those extreme weather events like the 2 hurricanes and the Boeing strike. Do you expect that those jobs will be reabsorbed into the data that we get on Friday?
Yeah, typically what we get when we have these types of one-time disruptions, one-off disruptions to economic data, is that we see a hit in the initial month and then a rebound in the subsequent months. So I think we have to be a little bit careful when we look at the underlying data for this jobs report, not to take too much or to put too much emphasis on strong growth in manufacturing, in leisure and hospitality, in professional and business services, because those are going to factor in some of the weakness of the prior month that is offset with strength in the month of November. So it's likely going to be important to average both October and November when it comes to the data.
We've seen Americans spend a record amount of money shopping online, both during Black Friday and Cyber Monday this year, according to the data. Does that equate to more jobs in the retail sector, and how does it impact inflation?
Well, we have a fairly moderate retail season. Consumers are still spending, but they're being judicious as to how they spend. We're anticipating holiday retail sales to rise about 3.5% this year versus last year. But as I mentioned, retailers are being also cautious with who they hire and at what wages they hire. And that's likely to lead to a bit more subdued retail sector hiring and employment over the holiday season. It's not terrible, but it is an environment where there is more caution when it comes to hiring just the right amount of individuals to be able to navigate this period of still high prices, high costs, and high interest rates.
You know, we talk so much about the headline number on the non-farm payrolls report that we get on Friday, but of course, average hourly earnings are part of it as well. And according to the data, we expect, at least the consensus, that those numbers might have slowed a little bit in November. What does that say about the health of the labor market?
Well, generally speaking, we're likely to see wage growth rise about 0.3% month over month. That comes on the back of a 0.4% increase in October. But we're likely to see wage growth momentum decelerate from above 4% to about 3.9%. It's still rather hot, but what we are seeing is a combination of wage growth deceleration along with strong productivity growth. And that is very important because that strong productivity growth offsets part of the cost of these higher wages and allows businesses to not necessarily have to pass on these higher wages into consumer prices. And that is all disinflationary, which is still very positive for the U.S. economy.
Interesting, Gregory. So we do have a Fed decision, the final one of this year, mid-December. Do you anticipate that we do get another quarter percentage point rate cut from the central bank?
I think it's likely that we'll get a rate cut in December. We are in an environment, as I just mentioned, that is still disinflationary. If you look at the broad inflationary dynamics, we're still moving closer to that 2% Fed target for inflation. And we are seeing, as we were talking about, a slight deceleration in labor market momentum. Nothing dramatic. The labor market remains still robust with an unemployment rate around 4%, but we are seeing gradually slower employment growth and consumers that are being more judicious with their outlays. So I think policymakers will want to recalibrate monetary policy a little bit more and then take a bit more time in 2025 with a likely rate cut at every other meeting. So 100 basis points of rate cuts expected in 2025.
EY Chief Economist Gregory Daco. Gregory, always good to see you. Thank you so much for
Always
joining.
A pleasure.